The Australian share market almost made it to a fresh record this week, helped by strong profit results. And I'll chat to Morningstar analyst Lochlan Halloway about that soon. But first, by the close on Friday, the market had drifted lower as tech and mining stocks were sold off and as investors weighed up geopolitical risk. By the close of trade, the All Ords was down 0.2%, the ASX 200 index off just a few points. And for the week, the All Ords and the ASX 200 index managed a gain of 1.8% each. AMP's Shane Oliver says after 3 years of weaker numbers, corporate earnings are rising again, led by the miners and the banks. This week, though, the market has weathered stock drops of up to 30% in response to results that miss expectations. The moves on Friday, though, haven't been as severe. QBE Insurance reported a 21% lift in net profit. Its shares were boosted by 7%. Telix Pharmaceuticals saw its shares rise 14% after it released upbeat 2026 guidance. But on the way down, GYG, the Mexican fast food chain's first half profit wasn't enough to impress investors. Sluggish US sales in a challenging consumer environment sent its shares plunging. GYG shares are now well below the $22 it listed at back in June 2024. Well, Morningstar's equity market strategist Lochlan Halloway says it might not just be the company results dictating the outsized share price moves, but the changing market dynamics around the way stocks are now traded. Lochlan Halloway, thanks so much for talking to me. We have seen huge price swings up and down, 30% in some cases, with the likes of AMP and Zip in response to the results that are being released during this reporting season. What's driving it? Are the expectations just that nuanced?
I don't think it's necessarily a function of the company results themselves. There's probably a bigger story here going on about the types of traders that are increasingly becoming a part of our market and the liquidity on the ASX. Over the last 10 years or so, we've seen the size of swings on earnings days increasing. That's been a pretty consistent trend now for almost a decade. It probably, and we don't know for sure, but it might have something to do with short-term money becoming a bigger part of our market, hedge funds, algorithmic trading, and the longer-term investor is kind of getting washed out here. So there's big reactions to the short-term stuff, but the first reaction is not always the most considered, and it may not be the right one in the long run.
So if you're an individual investor, you can't really compete with algorithms on a daily, weekly basis. How do you approach the market?
Yeah, I think it's very hard. I mean, these hedge funds have enormous amounts of time and money invested in algorithms and very intelligent people working on very complex computer programs to do this. So competing on the earnings day result, a beat or a miss, and how much it might move is probably not good hunting grounds for individual investors and long-term investors. But if you broaden out the time horizon and you say, I don't really care so much what happens on this particular earnings day or the next 6 months, but I'm a 3, a 5 or a 10-year investor or beyond, that's probably where you can do better, where you can take advantage of mispricings that these huge swings can create.
Beyond the swings that we're seeing, what is corporate earnings season telling you about the performance of companies in Australia?
All up, things look pretty okay. I mean, despite the enormous moves we're seeing on markets right now, we look at valuations, long-run valuations, and generally speaking, the vast majority of companies, we haven't changed our view on them this February. 2/3 of companies, roughly, we haven't changed anything. Things are going in line, not surprising, up or to the downside. So things look reasonable, and there are a few narratives going on here. I mean, one thing that's really helping the ASX right now is resurgent commodity prices. That's helping the mining sector and the ASX in general, which has seen earnings fall over the last few years. That's a good story, and generally speaking, things are going pretty well. At the margins you get swings, but that's just part and parcel.
And when we're talking about the miners, I mean, is there a broader story here about the return to physical assets, the need for these physical sort of resources, if you like, when it comes to electrification and renewables and building out data centres? Is that helping the miners?
Absolutely. I think certainly with regards to copper, I mean, the biggest earnings driver for BHP, which historically has been an iron ore mine, was actually copper this half. So the fact that the price has surged because of electrification demand, data centres and the transition. This is really changing the nature of mining in Australia, and it has supported those commodities like electrification ones, copper, lithium. Gold as well has done very well for different reasons, but generally commodities are on an upswing, and that's good news for the mining sector in Australia.
And AI is a big theme, not just here in Australia, but globally, of course. We've seen worries about AI eating into software margins and the spending associated with the AI build-out, if you like. What are we seeing in corporate earnings season in Australia? How is AI showing up? Is it in productivity gains yet? Is it disrupting? Is it job losses?
It's very early days, and I think looking back across the past 6 or 12 months, we're not seeing a lot of evidence in terms of AI showing up in cost lines or changing the nature of software businesses. We've seen big market reactions over the last few months, particularly in the software sector, big sell-offs for software stocks. That's more of a forward-looking thing. The market is trying to anticipate how this might reshape the landscape, not necessarily what's happening, but what might happen. We're at the first innings of the AI change, and I think for banks and insurers, they're talking about how it's changing productivity, make them more efficient and more productive. On the other side, of course, as you point out, we have the threats. To whom is this maybe a threat and a disruptor? So there's two narratives going on right now in AI, and in the conversations in reporting season, that's absolutely showing up.
Is there anything particular that you're looking at?
Well, the way we approach this new AI potential, the SaaS apocalypse they call it, right? The disruption that AI might incur on legacy incumbent software businesses, to try and look for those software companies that might be more impervious to AI threats because they have competitive advantages or moats. Things like a big switching cost. When you're deeply embedded inside your customer's business, it's harder to rip it out and it's harder to be competed away. So we're looking for those attributes to try and parse out who the winners and the losers might be of this enormous AI revolution.
Wesfarmers boss Rob Scott has told me that inflation is the biggest challenge facing Australia. How are we seeing consumers do in this reporting season?
Well, last year things were generally improving in the main. We had inflation coming off and we had rates coming down, and we saw spending pick up as a result of that. That narrative kind of changed towards the end of 2025 when inflation kicked up again. A rate hike came into view, which was a bit of a surprise to most people, and consumer sentiment turned down accordingly. We're seeing some of the momentum in discretionary spending starting to pull back later in 2025 and in the early weeks of 2026, we should expect. How that plays out is going to depend on how many more rate hikes there are, if there are any more, and how inflation transpires from here. But early on, it seems like momentum's coming out of the consumer market a little bit.
And are there worries emerging about a higher inflation environment globally, not just here in Australia, but there is talk of that as well in the US?
There is, and tariffs are a big part of that. Surprisingly though, it hasn't been, in the more recent inflation updates, it hasn't been extreme. We're seeing some evidence of it, but it hasn't really changed the inflation landscape there. And generally speaking, the Federal Reserve looks like it's probably still in a cutting cycle. I think in Australia, the inflation story is more around our productivity. The economy has started to grow again, but because we don't have a lot of productivity growth, it's sort of running into that speed limit quite quickly. And so despite the fact that growth isn't really booming in Australia, we're hitting the wall, and that's what's causing inflation.
We're in February, obviously, reporting season for the first half for the most. What should investors be looking out for as we head throughout the rest of the year?
Look, I think, of course, the way the consumer unfolds this year and how rates of inflation play out matters, but generally I think not so much if you're an investor looking at the next 6 or 12 months and trying to make big bets on what the RBA might do and what inflation might do. Is probably generally good sense. Looking at individual companies and businesses and competitive advantages and taking a longer time picture, not focusing on the very short term, I think is generally good sense.
Are there particular sectors that you like?
Look, there are a few out there. I'd say software and those tech companies at the moment are looking much more interesting to us because we do see a spectrum of companies. A lot of companies have sold off very heavily in the last few weeks, and we think that that's probably not fair in all cases. So we're seeing a lot more opportunities come up in the software space in Australia, but also our global software coverage.
Lochlan Halloway, thank you so much.
Thanks for having me.
Let's look at some of the other big earnings numbers this week. BHP revealed copper has replaced iron ore as the star performer in its portfolio. It also announced a $6 billion Australian silver streaming deal with Wheaton Precious Metals. BHP's net profit for the half year rose by 28% to just under $8 billion. Its revenue grew by 11% to more than $39 billion. Shareholders will receive an increased interim dividend of $1.03 a share. Rio Tinto posted a full-year profit of almost $10 billion, but that's down 14% on the same time a year ago. Rio earned less from Australian iron ore in the period. Shareholders will get a final dividend of $2.54 a share. The buy now, pay later firm Zip had taken a battering as it revealed an increase in doubtful debts. Its net profit surged to $52.4 million. The total reported profit was down 14%, but the numbers missed forecasts. Investors sold out. On the day, its shares crashed 34%. One of the biggest employers in the country, Wesfarmers, says inflation is the #1 problem facing Australia. The company made a half-year profit of $1.6 billion. Shareholders will get an interim dividend of $1.02 a share. Chief Executive Rob Scott told me the recent inflation numbers and the February interest rate rise have made customers more cautious.
Look, I think it's really important that we consider ways in which we can get inflation down. I think inflation is the #1 challenge facing Australia at the moment. That is why across our businesses we are really trying to take some accountability for what we can do to help Australians by improving the productivity of our businesses, which lets us lower prices.
And to economic data, when good news is bad. The jobs market has again been shown to be in rude good health. Workers landed tens of thousands of jobs last month, heaping pressure on the Reserve Bank to deliver a follow-up interest rate hike. All this as artificial intelligence shifts up a gear, threatening to change work as we know it. David Taylor has the story.
The fear is that artificial intelligence, or AI, is coming to take our jobs.
I have applied for probably about 50 jobs thereabouts in the last year, so it's just, a bit frustrating.
IT contractor Ron Skrusny worries the AI revolution will keep him out of the jobs market. He spent a lifetime designing back-end systems so customers can log on safely to their favourite websites, something artificial intelligence is now being trained to do, at lower cost than hiring Ron.
The savings are, one is the personnel, so a lot of the time you're restricted to 9 to 5 operations. So if you've got AI there driving it, that means you'll be able to then do it 24/7, which often is benefit not only to the company but also to customers and clients, whether it's the business or people who want to get things done out of hours.
Telstra recently announced it was looking to let go of over 600 staff as it slashes costs and accelerates the rollout of artificial intelligence. CEO Vicky Brady addressed some staff concerns around AI and job insecurity at the telco's profit results presentation today.
We have had to face into those decisions. They are necessary decisions to put us in a position to be competitive, to be able to deliver at the level we need to for our customers. Those benefits, today there's not a role I could say has directly been taken by AI.
But so far, jobs for real people have stayed strong. Unemployment has remained steady at 4.1%. In January, there were 1,900 fewer people out of work, while the participation rate was unchanged and close to the record high in January last year.
Overall, the figures today show that our labour market remains resilient. Our economy remains resilient, and we continue to have strong jobs growth in this country.
The Reserve Bank has two big goals: full employment and inflation at 2.5%. While it looks good on the jobs front, next week's inflation number will be carefully watched. And if it remains well above target for much longer, the Reserve Bank will be looking to cool the economy.
For some months now, we've had a second rate hike in our profile in May, and we have a 40% probability of a follow-up one in August. And these numbers really add to that narrative.
Job advertisements are on the rise for workers in manufacturing, transport and construction. But data from employment website Seek shows the going's tough for IT workers.
I think there's a lot of probably underemployment, that kind of thing, where people are just saying, oh, giving up, it's too hard. And I do know of others similar to me who are trying to find jobs, not necessarily in the same area as me, but they've been looking for quite a while as well. So it is tight.
A tight labour market for now, but with AI hard at work, it's an uncertain future for people like Ron.
And that is Finance for Now. Thank you for watching.